There are a couple exciting things going on in the market this week. We have several Fed presidents, including Jerome Powell, who will be speaking this week on the state of the economy, where things are going to go from here. Of course, we're going into a turning of the tides in Washington, D.C., so it'll be interesting to hear Jerome Powell's take on that. We have a couple of earnings coming out. There was some big news today coming out of one of the big companies, Intel. CEO Pat Gelsinger, he is stepping down. Well, he retired as of last night. So let's get into some stuff here. So last week, the S&P 500 and the NASDAQ both up less than 1%. Here's the calendar of what we have going on. So you see Christopher Waller is going to speak at 3:15 today. John Williams is going to speak at 4:30 today. You have a couple more. Austin Goolsbee is speaking tomorrow. You have job openings information coming out tomorrow. Where do we have Jerome Powell? So Jerome Powell is going to speak at 1:45 on Wednesday. Of course, you have your jobless claims stuff coming out. And then on Friday, we have a lot of economic data, which is the U.S. unemployment rate, the hourly wages that are going to be coming out. You have Goolsbee is going to be speaking again. You have consumer sentiment, which is the preliminary number. Now, talking about interest rates and where they're going to go. Last week, before Thanksgiving, Jerome Powell came out and said that, well, I don't know if it was Jerome Powell. It was somebody said that we are going to basically stay where we're at with interest rates, which was a very different tune than what we've been hearing over the past probably 3 to 4 months, in saying that we're just going to keep cutting. I've heard so many people talk about, hey, now I'm going to be able to go buy a house again because they're going to be cutting interest rates and it's going to be a more favorable environment. Or those that bought houses when interest rates were 7-8%, I'm going to be able to refinance. Well, I think there's a lot of things going on in the housing market. I don't mean to get on the housing market topic. I think that supply has a lot to do with it. There's just not a lot of inventory out there. Will interest rates help that? Yes, they probably will, because people will say, I can finally move again. I'm going to put my house on the market. Therefore, supply will increase. Let's look at the Fed Watch tool. So the Fed is meeting in 16 days from today. So the probabilities sit, current rate right here, you can see it. Target rate is 4.5 to 4.75. Wow. This is not what I expected. This is the first time I'm looking at this with you guys. So 65.9% still say, as of this moment in time, that we're going to get a quarter point cut. Wow. Even after last week when somebody came out and said we're going to probably stay where we're at with interest rates, I have noticed, well, I think about going to the store, going and buying stuff, etc. Now, I still feel that bills are higher. That's how I personally feel. I don't have any data to back that up of saying, yes, they're this percentage higher, this percentage lower, but put in the comments below, do you feel that inflation is coming down? Do you think that cutting these interest rates is the smart thing to do? I always worry about, I've talked about this for a year and a half. I worry about the double dip recession. I worry that you have, if you come over to my screen, I worry that you have inflation up here, and then all of a sudden you start cutting interest rates and inflation starts to creep down, and then interest rates just continue to plummet, and all of a sudden inflation skyrockets back up, and then you have to take your interest rates way back up, and this is what happened in the 1970s, and this is how you got to 17% interest rates. Maybe some of you remember, you talk about, your parents mention it to you. I remember my dad, he had a Ford Escort. It was one of his first cars that he came to when he came to the United States. It was 18% interest rate or something like that. It was absolutely wild. So it has happened, and it wasn't that long ago. And that's how that happened, because they started cutting interest rates too quickly. Inflation reared its ugly head. And to me, I don't feel like inflation is necessarily going away. That's just my personal opinion. But here we have almost 66% of the market saying that we're going to get another quarter point cut from the current rate, which is 4.5 to 4.75. So we will see. We will see what happens there. Something else interesting that happened this morning. Pat Gelsinger retired. Retired. I think they said, get the hell out of here and retire, or we're going to fire you and humiliate you. So Pat Gelsinger, CEO of Intel, he hasn't been there that long. I think he's been there for less than 4 years, if I remember correctly. I think he was hired in 2021, but he announced that he's going to retire. This has been an interesting play. These guys were struggling. You have your AMDs, your Microns, your NVIDIA. They started kind of taking the helm. Intel was a great company. They still have not hit the stock price that they've hit since 2000. Since the year 2000, they were $80 a share. Haven't even come close to touching it. They got to 60 maybe in 2022. But this was going to be one of those companies that was going to lead the world, going to be one of the first $1 trillion companies, et cetera. That's not the case anymore. Now they're really going for the foundry business. They built a $20 billion plant over in Columbus, Ohio. They built another plant in Arizona. They built a plant in Germany. They're going to be the foundry. They want to build chips for everybody else. I personally think they're spending their way to prosperity, and I don't know if that's the best way of doing it. I had once held Intel. I no longer hold Intel. And what worried me was the uncontrolled amount of spending that they were doing under Pat Gelsinger. I wasn't comfortable with leadership. And the second thing was, you remember the CHIPS Act? The CHIPS Act was supposed to help all of these companies, especially in the AI space, and none of the money was actually promised to Intel on paper, contracted. They were just betting that they were going to get some of that money. Last week, maybe the week before, they finally did get some of that money. I think it was like $4.5 billion commitment from the federal government. But I don't like things where you just spend, and hope things work out. And I don't like the reliance on government money. That's just my personal opinion. So I've moved on from Intel. But it is going to be a long play. They're up 5.3% this morning. They have an interim CEO right now who, Intel is named CFO, Dave Zinzer, as an Intel Products CEO, Michelle Johnston, as interim CEOs. Oh, co-CEOs. What's better than one CEO? Two CEOs. Great. Oh, my God in heaven. Okay. That means that one person can't do okay. They have two people doing the job of one person. Nice. That's great. This is just makes me want to get back into Intel. Not really. That is where I see Intel right now. Taiwan Semiconductors is also going to be supposedly a big purchaser of their chips if everything works out. So that's what we have going on in the market right now. The market today is, you can see, it's pretty flat. Oh, the NASDAQ's up about 1%. That's interesting. NASDAQ's up about 1%. Remember, tech-heavy NASDAQ. And if you look at the S&P, it's flat. It's flat. Then Dow, it's down just under 0.5 point. So when you start looking at these things, I would pay attention to some numbers coming out this week. And they're not official numbers, they're not government numbers, anything like that. Pay attention and see, what did Walmart do in Cyber Monday sales and Black Friday sales? What did Target do? What did Costco do? What did Amazon do? These are going to be very interesting space. And I would look at the discretionary numbers that come out of there. Look at the discretionary spending. Did people buy a lot of toys this year? Did they buy coffee makers? Did they buy things that you don't necessarily need? That's where I want to see, where are people feeling that the economy is going to go right now? Because when we look at spending, you have your necessities, of course, but then you have things that you don't necessarily need. Are people battening down the hatches? Do they think that inflation is going to come back up? Their bills are going to get more expensive. Where is consumer sentiment? That's going to be a big number to pay attention to on Friday. But I would look at those retail numbers, not official retail numbers, but see what they did in Black Friday, see where their sales came from. Were people just going and buying tons of stuff from Whole Foods when it comes to Amazon and getting bulk delivered? I don't know what it is. But these are the things that I would pay attention to if I were looking and saying, what direction is the economy going to go in the next 3 to 6 months? Now, as I mentioned earlier in the video, we have some earnings coming out this week. Nothing crazy in the beginning of the week, but when you get to the later parts of the week, you have Dollar General coming out Thursday morning, Lululemon in the afternoon, Ulta in the afternoon, DocuSign is an afternooner, Kroger, that'll be a good one to pay attention to. Do we have anything on Wednesday of note? Foot Locker, I know a lot of people in our community like Foot Locker, but you can see earnings season has certainly wound down. But again, I would pay attention to those two on Thursday. Look at Dollar General. See what happened in the quarter. To me, I think if things are getting tough, people are going to go to those discount stores. Now, Lululemon, I wouldn't put it in the luxury category, but it's certainly in the upper echelon of the athletic wear. See how their sales did. Especially, they're going to be able to report their Black Friday sales. See what happened on Black Friday with Lululemon. So when you talk about the month of December, people are optimistic, people are happy. I have this little article here from Yahoo Finance. So December historically ranks as the S&P 500 second best month of the year during election years with an average rate of return of 1.3% since 1950. So there could be some optimism in the market coming into the end of the year. You can see that there typically is. This is just something to think about. I do not think it should affect the way that you dollar cost average into things. I do not think that you should change your investment style based on month-to-month returns, saying that this is the second best month out of the 12 months. Usually, no. But it's just something to think about. maybe you get a little bit more optimistic, maybe you get a little bit more happy. Now, where does the valuation of the market currently stand? So if you come and look at this stock market to GDP tool, we're 120% overvalued. Fair value on the stock market is just under 3,000, 2737. Now, this is, I mean, when you look at it this way, think pre-COVID, okay? Pre just flushing cash into the market, okay? And of course, we were still doing QE, but look where we were, 60% overvalued. So you can see that, and where did we go? Let's go from, let's say here, 2015, we were pretty close to fair value, 11% overvalued. So it took from 2015 through 2019. So it took 4 years to get there to 60%, and it took another 4 years to get to 120%. This is the power of stimulating the market, stimulating economies, doing QE, just giving away free money. This is what you get. This is where you continuously, you're not letting cycles occur. Let recessions happen. Recession has become it's one of the worst words in the human language when it comes into the economy. You can't have a recession. God forbid we have a recession. Well, if you just let a recession happen, you're not going to have a dramatic depression where you need to stimulate the economy. Just let things happen. Let the cycles happen. Every 8 to 10 years, yeah, we're going to have a recession. It's just going to be healthy. Then we're going to get better. Now, look where we're in just such uncertain times. 120% overvalued. If we look at the 10-year CAPE, same thing, about 125% overvalued. Fair market on the S&P is about 2,700. It's that same range. So, guys, market's overvalued. Doesn't mean you just stop buying. No, it doesn't mean you stop buying. It is what it is. Will their market pull back at some point? I don't know. It's fragile, that's for sure. But the moral of the story for me, when I look at these types of numbers, is we need to get back to just letting economies be economies. They're going to ebb. They're going to flow. They cannot just always flow. You just can't do that. Think about it as a pendulum. If you have a pendulum here and it's swinging, your normal swing is probably goes to here. This is on the good side and this is the bad side, right? And the bad side will swing right back here and it just continuously swing. You cannot just try to keep things good up here. It's just not going to work because what's going to happen with that when that pendulum swings back down? It's going to go like this. Now, instead of the pendulum swinging like this, what have we been doing? Well, we've been grabbing it right here and saying, hell no, we need to just dump a ton of money in and try to push this thing back up, and we're probably sitting somewhere in here. That's not how economies work. I'm going to say it till I'm blue in the face. And unfortunately, there could be a very, very bad event that occurs due to the mishandling of everything over the past 10, 15 years. If you guys are not subscribed to the channel, please subscribe to it. We did a video on how to invest at these all-time highs. Click this video right here. Go check it out.